Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Beko and Hari.
Hello.
Welcome back to Value Investor TV. Hari, it's been a while.
Yeah, it has been a while. Things have been very crazy everywhere. So
Everywhere.
it's good to be back and good to talk to everyone. And I see we have a lot more viewers now on YouTube. So welcome all of you who are on YouTube, and we hope you keep tuning in.
Awesome. Well, I guess I'm just recollecting my memory here. I don't know when the last time was that you came on, but I think we talked about kind of the market commentary, and then we had a string of folks who just a special guest. So definitely good to have you back, Hari. And so to start us off, I think let's hear that disclaimer. It's been a while.
Everybody's favorite. This is the Value Investor TV podcast. We are a podcast that helps you understand the concepts behind investing and value investing. We are not financial advisors. We don't know your specific financial situation, so please consult with the appropriate advisor before making any investment decisions.
Okay, excellent. And also just a few housekeeping items. Hari mentioned that we are on YouTube, so we are indeed on YouTube, everybody. So if you guys are listening via podcast, you'd like to consume us via YouTube, please feel free to check that out as well. We also publish small clips, so small highlights of when we are talking about something very topical, we will snip that out of the entire podcast and post that segment on YouTube. You probably have seen something like this in other podcast channels, so we're doing something similar there. So please check that out. And then lastly, we are slowly building our Patreon page. It is live, but some of the content is not complete just yet. But keep that in mind as we move forward. We would appreciate any sort of help to enable the continuation of this podcast. Anything to add on that front, Hari?
Yeah, if you are watching us on YouTube, please like, comment, and subscribe, and hit the notification bell. That'll help us quite a bit. We're trying to grow this channel as much as we can, and the comments help us a lot with the YouTube algorithm, so we'd appreciate it if you can just leave a comment.
Okay, awesome. Cool. So in this episode, let's talk about kind of high-level macro stuff, namely the stimulus package. And obviously with the coronavirus, there was a stimulus package that was passed. And, here we're talking about the U.S. stimulus package, but stimulus packages all around the world has been passed. The entire money supply over the entire world has increased quite a bit with the stimulus package from federal central government, Federal Reserve. And here, shortly in the U.S., we're about to pass another stimulus package. So I thought we'd take a moment here in this episode to talk about that. Hari, you've been sort of up to, you've been reading about it, been sort of up to date on this. What's your take on the stimulus package and what that means for the stock market?
Yeah, so the big thing is that the economy being shut down in many states has kind of led to a huge drop in output. From places especially places that have been hit hardest are things like the hospitality industry. And areas that have been shut down specifically. And then other areas like you've seen big tech and things like that have been growing over the last year. So the stimulus is kind of there to boost the economy in different areas, different sectors that have been hit. So the first stimulus package was targeted loans to small businesses. And as you would expect, because it's government, there were a lot of people who took advantage of these small business loans that didn't actually need them. There were people who they were eligible for, but didn't want to be beholden to, the restrictions that were there. And we also saw things like Southwest Airlines. The airlines got these big bailouts to to keep their employees, keep them from being furloughed. So what we're seeing again is similar kind of things, right? That the stimulus is there to kind of help um, businesses that are hurting, but there's also a lot of things that are thrown in there around government, state government protection, which was not in the previous bills. So why does that all matter? Well, it matters because insolvent government is obviously a terrible risk for the economy at large, but it also affects individuals that are going to have and so right now there are a lot of unknowns about who is going to be able to benefit. Just like when the first big round of stimulus was passed, we don't know who all is going to be able to exploit this, what all the provisions are in this. I think Wall Street was kind of hoping that using this as a kind of a yardstick to say, oh, it's a very large number, and so therefore businesses are going to, prosper after this. But the reality is that it's like everything. It tends to help the businesses that are publicly traded, that are large, that have the funds and resources to exploit, what is available. So that means that you are going to see, I think the market, we're recording this on, Sunday night. The House has passed that over Saturday night. So the Dow futures are already up, 200-300 points as a result. So I think Wall Street is going to take this, well, because this is money that's going to, flow in. But that doesn't necessarily mean that we are not going to see a lot of restaurants, a lot of smaller businesses that are failing, right? And that actually has downstream consequences, because those are the people who then buy from the Amazons, the publicly traded businesses also. And we are also seeing. Oh, go ahead.
No, you got it. Close out.
Yeah. Last thing I was going to say is that there's been a big uptick in unemployment, right? More people asking for unemployment, and than were expected. And that number is going to probably continue to grow, I think, as more of these small businesses who are kind of holding out for what the stimulus would look like will start to shutter. So
yeah, no, I think honestly, like the stimulus package, obviously it is going to be very helpful for some people, but a lot of people are going to abuse it. That's just kind of the nature of these sort of large omnibus sort of stimulus checks, I think. As we have seen in the previous rounds of stimulus checks, this one also will be like that. It's almost like to your point about Wall Street. This will be a giant gift to Wall Street. This will be a giant gift and boon to the stock market. It'll elevate the stock market, and then people talk about L-shaped recovery, and now people are starting V-shaped recovery, L-shaped recovery, K-shaped recovery.
yeah,
Right. And I think this is an example of sort of like a K-shaped recovery sort of paradigm where you have these tech-focused, tech-forward companies, ripping through the stock market, and then you have the real economy, so to speak, like the Main Street, right? People who own small shops, small businesses, they're not really doing so well. So you got this divergence of tech focus or stock market, big large corporations, and then from kind of sort of the mid tier to low tier market. And so I think that it might kind of exacerbate the issue
yeah,
to some extent.
I
And
think.
then, like, to your point about unemployment, right?
Yep.
Unemployment number doesn't really help in this regard, and so yeah. So you were saying, sorry,
Yeah,
was
just
going
the
to say something.
one thing I'll say is that the last week or so we saw interest rates actually tick up a little bit, which was devastating to tech companies. So for those of you who are kind of new to this, game, the interest rates, when they are so low, benefit the companies that are, by inflating their price to earnings, essentially. So the multiple that they trade at is much higher than if it were, an interest rate of say 5%. So we are seeing historically low interest rates. That's why we're seeing historically high multiples on investments, because bonds are not attractive right now. So the money is now being pushed into the stock market, right? Because people can't get a rate of return on the bond. So when the bond yield goes up, which is it has been the last week or so, people move their money out of stocks and put it into the bond market. So, and the bond market is typically very, very large. We're talking in the multi-trillions of dollars. So movement in, that's why you see a huge uptick in the stock market these last, 5 to 6 years. So the biggest risk I see is that if interest rates rise, we may have an interest rate recession. Essentially, the stock market crashes as a result of interest rates going up again.
Mhm. This is exactly the kind of same sort of paradigm that happened maybe 3 years ago or so, where the interest rate was starting to go up little by little because economy
Mm.
was doing well.
Yep.
And so when the economy is doing well, you think that the stock market would do also well, but then you have this intermediary, which is the interest rate, and people look at the stock market through the prism of interest rate. And when the interest rate goes up because the economy is doing well, the stock market actually paradoxically craters. It's
Yep.
just like Warren Buffett. I think Warren Buffett or Charlie Munger, one of the two. They always say interest rate is like gravity to the stock price, and that's what we're seeing
Yep.
right now. That's what we saw this week, and I think it'll be interesting to see how that unfolds with a new round of stimulus check.
Yeah. And I think we're gonna have to have you know the same things apply here. You're looking at the K-shape part of this. There are lots of businesses in the retail sector and things like that that have not, they've done pretty well in the last, the fourth quarter, but pretty, they are, much at risk, with an interest rate rise also. But you're also seeing their risk too is that if unemployment, remains high, there is going to be a, smaller group of people who can afford, to buy things, right? And that's where things, can really hit them. So the as it is in 2008 and basically every recession, the upper middle class groups are typically okay, and it's the lower middle class, which makes up a very large percent of the economy that isn't able to afford anything. So
Hmm. Yeah, I mean, obviously, the income inequality is exacerbating, and that's not good for the entire economy as a whole. So it's something to watch out for, something to be kind of mindful of as we're analyzing at the macro level. Um, awesome. Anything else you want to add on this topic, stimulus?
no, I think we'll next episode we're going to be talking a little bit more about inflation and the money supply a little bit more. So we'll have some more to add to this discussion. So uh, I hope you'll tune in for that one as well.
Okay, excellent. This is a short one, guys, just to kind of warm Hari up. It's been a while, but
Yep,
I'm
forgotten where
glad you guys
everything
joined
is.
us.
Yep,
All right. Well, thank you guys for listening. I'll see you on the next episode.
thanks.